Good morning, James.
Morning, James.
Thank you very much for doing this again. I think it's about over a year since we did it last time. But nevertheless, could you just sort of start off by running through what Edinburgh Trust is doing and how it's being managed and what it's trying to achieve, please?
Absolutely, James. So I'm going to canter through this at some pace and we can come back to points on questions if you wish. So first slide, I love having first slide as performance. You can see here, since we've taken over the mandate in the teeth of COVID, on the right-hand side, the numbers there, you can see in absolute and relative terms, they are distinctly respectable. And I think it's worth bearing in mind there's loads of different chapters that we've had to adapt to in that period. So next slide, please. This is a dry old slide, but sets out the objectives and the like. What I'd say about this is, the twin objectives, we've met one, not met the second, but actually by achieving a good total return, I would argue actually that we've done a tolerable job, if you like, against some quite elevated inflation over this period. How we've done it? Well, we've done it by employing the same style that we've done for some time, which is this flexible, so no enduring bias towards growth or value, and a focus on total return, which is basically not prioritizing or bias the portfolio to income at the expense of capital. And, we're lucky enough to have a good team who spend their days really looking at the guts of companies, the strategic positioning, and very much ESG is integrated throughout. Risk, as you'd expect from a business like Liontrust, top quality. We've got, I think, the right bias of number of stocks, 40 to 50 stocks, with a bit of a rifle shot of sort of non-UK listed stocks where appropriate. And then as the board did an RNS in the last month or so, they've announced that I've decided to retire in early 2024, and Imran Sattar, who I've worked with not only at Liontrust and predecessor companies, but also back in the day at a firm called Mercury, is to become the next portfolio manager. But the key point is he will be ploughing the same type of process from the same team. Next slide, please. So investment approach, pretty simple. Again, we can come back to this in questions, but we spend about a quarter of our time looking at the macro. So if I put this in the perspective of like a company like Tesco, which I met yesterday, had results last week. I think what you've got here is obviously it's a pretty competitive environment, but what we've got is not undue capex coming in. We've got disinflation coming through, and that's actually not a bad backdrop for Tesco to plough its strategy of, if you like, nibbling market share from all players. And I think it's doing that by a pretty clever strategy, as you know, the Aldi price match, which anchors value, and then the club card piece, which is, if you like, sort of icing on the cake. And the good thing about this one is I think that the forecasts are very doable. Expectations are low. This is a business that calibrates its profits in a way that works for society. So I would say ESG is integrated. And what it's also got is a future facing part of the business, which is obviously Clubcard, which reaches some sort of on the app 16 million people, and obviously the digital sort of card side a further 7. So what we've got is a business that's future facing and a bit of a parable for the UK. And James, you alluded to this when you were talking about the European trust. I mean, UK companies are cheap. This is a perfect example, which has a high free cash flow of just a whisker under 10%, distributing 4 by dividend and 750 million per annum a minimum in share buybacks. So we've got one of our top 5 active positions. Next slide, please. So this is This is really just an illustration just to show, I think, how much has changed really since we last did one of these. I mean, this was encapsulated the feeling, if you like, of the time on the left-hand side in November last year. And next, where we are currently is the news has improved a lot. I've taken this from the Lloyds Bank Business Barometer. It's a long-running series. I could have taken the GfK data, but what it shows is the consumer confidence in GfK is better, and business confidence here in the Lloyds survey is better. And that's just a good enough environment for us as a team to find companies that are on the strategic front foot, gaining share and showing blue water in terms of their sales growth relative to pre-COVID. Next slide, please. This is just a bit of an advertorial, if you like, for the UK equity market. And those of you listening who are, nicely close to markets will be well aware of this, but it still, I think, warrants the advertorial, which just really shows that the UK is in free cash flow. So this is next 12 months free cash flow taken from Goldman's, shows that it is highest amongst the international universe. And even if you adjust for the fact that, yes, we have quite a lot of banks which are relatively low growth, or international energy companies which are cyclical, arguably, this still wouldn't change necessarily the absolute shape of the left-hand graph. And the right-hand graph is also just showing that actually a lot of that cash is coming back to shareholders. So you can see the dark blue is the dividend yield, the light blue is the share buyback, and the red or orange is the combo of those. You're getting a decent amount back. And, I'm often asked in meetings, so, what's the catalyst for the UK equity market? Well, in essence, what is happening, as we know, is there's a lot of selling by retail and wealth managers of the UK as they respond, I think, to the growing weight of the MSCI in the overall index. And what we are seeing is actually companies take the other side of that, and I'd much prefer to be on the side of companies than the former. So next slide, please. This is just a little flavor, if you like, of what we've been doing over the last 12 months, and we can very much come back to this if listeners wish to focus on any of these. But just I think a nice little illustration might be that, a Reckitt was sold and we bought Haleon. And I think Haleon, in a way, speaks volumes, because the press is all about UK companies moving and relisting to the States. Here is a picture of a company that has demerged from Glaxo, decided to list on the UK stock market. What it also was, and we really like demergers relative to IPOs, because they tend to be much, much less juiced. And in this instance, it actually was demerged at a time where there was almost an orchestrated fear around Zantac liability. So it gave us a good opportunity to buy into a peach of a business. And why I say peach of the business is that this has got fantastic brands in some very strong growing areas. So if you look at consumer healthcare, a lot of them are struggling to grow volume. This actually is growing volumes nicely. The last figures were sort of 3% volume and 6-7% price. Contrast that with Reckitt's negative volume. So, this is chalk and cheese, and Haleon listed. The laundry list of things people don't like about it focuses very much on debt, but actually this is a business with strong momentum, strong white space, and one we've been buying a lot of in the last 12 months. Next slide, please. So this is a slightly complicated slide, but what I'm really trying to show is, for us as a team, if we're looking to endeavor to outperform in most chapters of the market, I think you need a number of themes in a portfolio. You need to layer it. You need to be flexible. And so what I've done is labeled this and thought about the sort of various themes that are in there. And again, we can come back to this in questions, but one of them I would highlight is Darwinism. So this idea that against a pretty tough environment, but an environment where the pulse is a bit better, actually the market share that accrues to the number one and two in a market is outsized. So just think Premier Inn. Think about Premier Inn's competitive set prior to COVID, and think about it now. Travelodge, frankly, pre-pack waiting to happen again, probably. Then you've got the independents all struggling with gas bills, and the field, if you like, is open for the likes of Premier Inn. I put down ESG rehabilitation, which we can come back to, but here the key point is that this isn't a static thing, is the key thing I would say. And you think about that through the lens of the banks, or indeed the defense companies, which arguably are very important for things like SDG 16. So next slide, please. This is a curiously dry slide, but what I'm really trying to do is just show listeners what are the size of the active bets that we have in the portfolio. And we can come back to any of these that you wish. And what I'd also say is that what we also have, so in that other on the bottom left, you can see that we have 8% in non-UK listed shares, which are all rifle shot using our global team. So the likes of Publicis, for example, in media and transformation, Intel, for example, or Novartis in pharmaceutical, to name but three. Next slide, please. So in terms of summary, really what we're at the past the 3-year proof point. The numbers, as I showed on the first slide, are reasonable, and both in relative and, more importantly, in absolute terms. And what makes us excited about this trust at this juncture is that it's invested predominantly in the UK, where valuations are standout. And if you access this through the trust, you, if you like, get discounted shares, so UK equities at a discount as well. So I think of that as a double discount, if I'm honest. So I will pause for questions there. James, over to you.
Thank you very much. Let's talk a bit about portfolio construction stuff first. In terms of like position sizes, how do you decide what a position size should be, and is there a kind of upper limit to them?
I think obviously one's looking at the overall risk in the portfolio. One's looking at the impact of a particular share on a particular factor. So for example, if I'm looking at Centrica, okay, I will think of it in the context of my overall international energy company exposure as well. But the simple answer to your question, James, is that we're unlikely to have an active bet that's more than 6%.
Okay, that's fair enough. Now, in terms of sector weights, I don't know if did we have a chart on that? Don't we? Did we?
We don't actually know.
Is that something that you think about?
Yes, I do think about. I mean, some of the bigger sector weights we have at the moment are geared towards consumer discretionary shares in total. So we have quite a lot of retailers, quite a lot of food retailers, a decent chunk of leisure exposure, and obviously banks. And why we have that currently is somewhat counterintuitively, actually. consumer discretionary shares tend to do best when the news goes from, if you like, sort of catatonically bearish as it was in November when we last spoke, November 2022, to a bit better as we are now.
Fair enough. You've got no small caps in there. Would you ever hold small cap stuff?
Well, ever's a long time, isn't it? But I mean, I think share owners in the trust should expect us to be focused mainly on FTSE 100 and and 250.
Okay, fair enough. You've got you got some oil, obviously. I think because there's two questions here that we can sort of tie together. So let's talk about Shell a bit. So how does Shell fit in from an ESG point of view? And then can you just explain the rationale for why you like it, please?
Yeah. So in terms of Shell, simplistically, if you look at it through the lens of, the SDGs, it's, if you think about number one, which is no poverty in the world, number seven, which is clean and sustainable energy. The reality is, let's say theoretically, all the international energy companies were to stop producing, that would obviously lead to a divot in SDG 1. And also, if you think about what Shell has done, and I've covered Shell for a long old time, actually quietly, and it's a big contrast, frankly, to some of the American international energy companies, it has quietly exited the high carbon producing forms of hydrocarbons. So, it exited its Canadian oil sands and has gradually moved to a world leading position in LNG, which is one of the cleaner forms of energy that we can access in size. And Shell now, after Qatar, is obviously the biggest purveyor of LNG. It's a very, very strong position. It's got very strong positions in marketing, which is, petrol and the next phase of EV in due course. It's got a strong balance sheet. It produces a strong yield and is investing in a measured way in next generation renewables. And, we need companies like Shell, I would say, if we are going to transition. So it's cheap, and also it is, I think, an agent of change that is moving at the right pace for society.
Okay, fair enough. I know we could talk the same thing about Centrica. I know Centrica gave me a lot of criticism last year when gas bills started going mad and that sort of thing. Is that something that you thought about when you're investing in it?
Absolutely. If you're investing as we do on a 3-5 year view, you've got to think about exactly how a society's profits fit, a company's profits fit into societal norms. And the reality is, as we know, that is one thing that politicians agree on is the lightning rod that is the heating, electricity bill, and the like. And obviously, with them doing a moonshot, they were in the spotlight. But I think if you take a step back, actually, what you've got is you've got a business that has contracted long its energy, and it's done that to create energy security for the UK. So, the last 2 days we've had problems with Finland's pipeline and the like. So, what Centrica does quietly has been very important, I think, for the UK. And that's one point. The next point is that it is not making outsized margins on its bills. if you look at the margin that it makes, it's a very low margin. It also, unlike some of the other suppliers, it actually has within its customer base um, all elements, if you like, of deciles of incomes, whereas some of the more newer providers generally have just the direct debit customers who tend to be the richer customers. So it provides a societal positive there. It also, if you look at the last few set of results, has given or allocated the highest amount of remedial income to customers who are struggling. So that's the nowcast. Then the next problem we have in the UK is if you look at our carbon footprint from housing, it's just dramatically higher than France or Germany, and we've got to do a lot with our housing stock. And in doing that, we need, frankly, the likes of British Gas, because British Gas engineers now looking at your boiler may actually in due course be looking at sort of heat pumps and the like. So I would say British Gas is a business that actually quietly is very much rehabilitated. And if you want the evidence of that, look at the change over the last 3 years in how The Guardian has reported on British Gas's profits is dramatically different in the last 12 months.
Okay, thank you. Few questions around banks. So first off, it looks as though you've got an underweight to financials. Is that true? And can you talk through the reasons for that? And then specifically, why do you like NatWest and why are you underweight HSBC?
Yeah. So yes, underweight financials, and that's primarily driven by the fact that we're a bit cautious on property companies. We can go into that if you wish, but it's just really the rising cost of finance and the impact on NAVs. We're a bit cautious on life assurers and the sort of nexus of sort of wealth management, and part of that is the complication in life assurers, and part of it is, I think, the pressures from consumer duty. And yes, you're right. In terms of banks, we own, chunky amounts of banks, and the big picture on banks is that it's been a long march since the last, since the GFC. They've had to quite rightly raise a lot of capital. We're now at the stage, though, where profits equals distributable capital in the main, and regulators recognize that. So actually the dividend flow and the share buyback flow you're seeing from companies is really pretty, it is outsized. And so for a fund like this, it makes sense to have a decent amount in it. So why NatWest and why sort of a bit less in HSBC? So NatWest is a business that obviously is gradually coming out of state control. We're now down sort of to high 30s%. And, over the next 4 or 5 years, that will drop to sort of something like 20 something. And that will then mean that it can become a sort of normal company, if you like. Meantime, what we've got is a business that actually, in terms of cost income ratios, net promoter scores and the like, is all moving in the right direction. And yes, there's been quite a lot of column inches on the Coutts issue and the like, and no doubt there'll be more on that. But actually, I think it's a relative sideshow compared to the reality that actually, NatWest, both on the corporate and personal side, is a really strong business, which allows it to distribute quite a lot of capital, and the valuation at at a 25% discount to NAV is pretty cheap. And coming back to sort of why not a lot in HSBC, well, we got 3% in HSBC and we got 2% in Standard Chartered. And I think you might say, well, why don't you have 6-7% or whatever in HSBC? HSBC, I think, is a strong business, and actually, I have to say that under Quinn and Tucker, the chief exec and chairman, respectively, the pace in that business and the pace of execution is enormously quicker than how it was before. But the postcode in which it operates is one that's fraught with a little bit of risk. If you think about its nexus between, the US and China and Hong Kong and the like. And so it's against that background, what is frankly, a cheap share that offers a nigh on 8% yield and is buying back shares. I just think one needs to aim off a bit. And so we've only got 3%. And we've got, as I say, a reasonable amount in Standard Chartered. But I am, really, make no mistake, positive on banks.
Okay, good. Let's go the other way. Now, what you've been buying and selling. So a specific question about why the switch from WPP to Publicis?
Yeah, so I think both are good businesses, but just at the margin, WPP, which under new leadership has done some fantastic strides. If you think about the de-gearing that it did, it has changed enormously, but it's still dealing with some of the legacy issues from the previous era. Whereas if you contrast that with Publicis, which hasn't had the scale of those legacy issues, and in particular has made over the previous decade, 2 acquisitions, Epsilon and Sapient. And both these businesses have really, I think, driven outsized growth relative to the industry. And, both of them are very much focused on data and, the future, obviously, of media and corporate transformation, if you like, is obviously focused on data. And it does look from the market share data, and Publicis reported some results yesterday, which, if investors want to click on their website, you can see that they upgraded all their forecasts, pretty substantially, which is quite an achievement against a, quite a tough background. So, we've just reorientated from WPP to Publicis.
Okay. I mean, in terms of what drives sales, I mean, how often is it valuation driven, or is it more about what's going on within businesses?
It's more a view on, I mean, obviously valuation is a piece of that, but it's more as a result of our, fundamental research, meeting the companies, a judgment on the strategic position, the growth potential over the next sort of 2 to 3 years and the like. So, Reckitt, for example, it's been a strong business, but now the volumes just don't look like they will outperform the industry, and it has less white space, by which I mean easy markets to expand into, whereas Haleon is the reverse.
Mm-hmm. Okay, that will make sense. If we think about, I mean, obviously this is a UK fund, and there's not much you can do. You do have some overseas investments, but do you see any catalyst for a kind of re-rating of the UK, because the valuation gap between it and other markets is just carried on widening?
Yeah, so sometimes that doesn't have to be an explicit catalyst really to drive markets. Sometimes it can sort of creep up on you, if you like. And, I would say that when flows, and I'm sure that many a listener has seen the data where you can see, if you click on data providers like Calastone, they have infographics which show the scale of fund flow into global and bonds and out of UK equities. And we are where we are. The market has absorbed all that selling. The other side of that is, as I say, often corporates buying in. And I think in due course, given share prices are a mix of supply and demand, I think that demand from corporates will tell actually. So I think we could be surprised on a 3-year view what the UK equity market could do.
Fair enough. Talk to us about gearing. So what drives the level of gearing in the fund, and what sort of range do you operate in?
Yeah, so gearing is if you like, a good story if we take a step back, because hitherto, sort of 2-3 years ago, this was a trust that had debentures that were had a coupon of a 7 handle, 7.75. The board and my colleagues, James Mowat, took the decision to refinance that debt. And so we now have debt in various tranches with an average tenor of 25 years that has a coupon of 2.44%. So if you compare that obviously to gilt yields of similar tenor, which would have a 4+ handle, you can see that is good to have for the trust over the long term. In terms of how we use that, we've used that pretty much in its entirety at the moment because, as I hopefully made clear to listeners, we think the equity market at the moment, the UK equity market, is relatively cheap, and it makes sense to use pretty much all the gearing as a result. And I think, frankly, it's going to be rare for us to not use any of that gearing, because with a coupon of 2.44%, it makes sense to utilize it.
Yeah, totally. I mean, what's the portfolio yield at the moment?
It's a nose under 4.
Okay. So obviously you're making a margin on that, which is helpful too.
Absolutely, yeah.
Good. Okay. We've got another specific question on the stock. Diageo. Why underweight Diageo?
Yeah, so Diageo is interestingly, over the last 12 months, it's been a pretty ugly share, actually, having been obviously for the last sort of decade or so, a very good share. And the way we thought about this one was that actually a lot of Diageo's profits growth has been driven by the stellar profitability and demand and premiumization that we've seen in the States over the last sort of 10+ years. And I think people have forgotten that in 2008 there was trading down, and so we sold our Diageo about 18 months ago because we were nervous that as the stimulus checks, if you remember those stim checks that went into the States, a bit of those would have gone into, spirits and sneakers and that sort of thing. And what we've seen subsequently is we've seen trading in the States, come off the boil. And frankly, we're seeing slightly negative volumes for a number of the Diageo brands. And, this is a business which hitherto was almost walking on water in terms of its market share gains, but actually now those market share gains are not what they were. And, the rating is still quite high, frankly. And I'd much prefer to be in the likes of Haleon. And also there's a slightly sort of awkward issue, which I think the company has parked for a long time, that alcohol alcohol is not a million miles away from things that cause problems, basically.
Yeah.
And I think one needs to be cognizant of that as an issue as well.
Fair enough. Fair enough. In terms of sort of outlook for the economy, are you in the camp that thinks that rates are going to be higher for longer, inflation might be a bit more stubborn? Do you see a recession next year? That sort of thing?
So I think what we think is that compared to sort of 12 months ago and sort of whisper expectations, the growth pulse is a bit better than people thought. And to me, the key development over the last quarter has obviously been the advent of disinflation, which I think is good because it at the margin leads to the Bank of England possibly being able to sort of back off too much tightening. So that's sort of the good news. In terms of sort of will there be recession or not, I would err on the side of the not. But the bigger thing that we focus on is very much the companies themselves. I mean, in our investment process, I said, really only a quarter of our time spent on the macro. The big thing we focus on is, the companies themselves, the strength of the market position against that. So, relatively a bit more positive, I would say, than embedded expectations on the UK, and particularly on the strategic progress that the companies we own are making.
Now, you said at the beginning, you've got two objectives, and one of them is to grow the dividend with inflation. How long do you think it takes for you to catch up and surpass inflation again?
Well, so the dividend the last year grew of the order of a bit over 5%. We've got a dividend now that is within a whisker of being covered by the underlying revenue or dividend that comes off the portfolio. So we're in very, very good shape there compared to, I think, our well, in absolute terms and compared to our peer group. In terms of sort of how long it takes to pick that up, I mean, inevitably the dividend decision, frankly, James, is obviously a board decision rather than our decision, if you like. So it's difficult for me to answer that, but I would say that we're in good shape. And I come back to the previous point which I made and in the sort of initial slides, which is, if we get this total return piece correct, actually whether the dividend grows at 5, 6, 7 or 3, 4, 5, the more important thing I think is if you like to get the total return bit correct in the short term.
Don't compromise the capital growth for the sake of dividend. Exactly. Good. All right. Thank you. I think we covered an awful lot of ground there. I think we should leave it there. But thank you very much for your time today. I think it's interesting. And good luck with your retirement. I don't know if you'll come back as a director of things. We'll see you again. But
well, I'm sure I won't be idle, but thank you to listeners, and thank you, James, for hosting that. I've really enjoyed that. So have a good weekend.
Thank you very much. Cool. We're back next week talking to one of the managers of the renewable energy funds. So Tom Williams is here from Downing Renewables and Infrastructure. They've got quite a good story to tell, I think. We saw them yesterday, and it does sound encouraging. And then the week after, we've got Richard Sen from Pantheon Infrastructure. And then we do have a sort of full lineup all the way through to the end of the year. But actually, unfortunately, we've lost Taylor Maritime that we did think we were going to have the 10th of November. But we think we've got a replacement lined up for them. So have a good weekend, and I shall see you next week. Thank you.